Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
We are going to start today just a little bit different here with a conversation about social impact investing, which has always been a big focus of the Milken conferences. Carlissia Graham is the president of New Media Ventures. It's a venture fund for early stage media and tech companies, but with a mission to advance a multiracial representative democracy. Great to have you here on the Bloomberg stage here. So to break that down for us, because we talk so much about, I guess, impact investing, and that's such a broad umbrella. But specifically for what you do at New Media Ventures, what is the goal?
Yeah, the goal is to resource folks who are thinking about a way to enhance democracy through their innovation or through their startups. We spend billions and trillions of dollars every year investing in R&D around healthcare or science or cars and all kinds of sectors. We don't put nearly any of that toward social impact or toward democracy, right? Who's thinking about ways to prevent voter discrimination or voter inaccessibility in really good ways? Well,
but sort of make that palatable for me, right? Because I know how to invest in a car or, a factory, something that's more tangible. When you say investing in a business that is somehow going to advance our democracy, what does that look like? Are we talking about media companies and media influence or something different?
Yeah, both through media influence. I think media has a huge role to play in our democracy. What people have access to in terms of information, civic mobility comes through media as well. So media plays a really big part in that, as well as civic technology. Are our voting systems built to actually sustain the level of voting we expect to see and the demographics that we hope to see? So it plays a part on both sort of like the technology side as well as media.
So let's say, what are the kind of deals or the deal pitches that come across your desk or in your inbox, if you will, and what is it that makes you say, okay, that's something I want to back?
Yeah, I think the ones that are focused on people power get our attention the most. So if you are building a company that's going to get more people to vote, then yes. If you're going to building a company or a media company that is representing underrepresented audiences, so Blavity is one of our major investments. Blavity is one of the top publications for millennials, which isn't a political publication, but they do so much to change the lives of that population. That for us is a sentiment of democracy.
So much of the conversation, here we are getting ready for the November elections here in the United States, is where are people getting their news? Where are they getting their information? Where can you trust it? How do we make that better? It sounds like that's what you are working on.
We just launched a new initiative called Voices for Democracy last year, where we're investing in folks who are reimagining what local news looks like. And so folks who are building trusted audiences, and particularly like rural communities or news deserts, how are we giving them the seed capital to see if those ideas work? Can we reach those audiences that we normally won't be able to do?
Have you found a viable business model for that? Because one of the reasons why we've seen the disappearance of local news is a lot of people really couldn't make the economics work, particularly after all those advertising dollars flowed to Facebook and Google and the other online companies.
Which is what we're testing, right? And so we have this huge portfolio of national media brands that we've helped to build who have multiple sources of revenue, right? They've diversified their revenue structures to make them sustainable. We want to apply those same concepts at local. So we're testing whether those new ideas, those new business models will work, so we can relieve the pressure off philanthropic capital.
But do you think that can be done strictly on a for-profit basis, or you still need a nonprofit component?
I think you're going to still need a nonprofit sector as well, and so we're operating on both ends of that. So we do nonprofit investments, nonprofit grants, and for-profit investments, and we're trying both models. I think sustainable revenue is important in both situations.
Yeah, we'll talk just a little bit more about revenue because in the media space, right, everybody's going after the ad dollars, but it's really competitive. Having said that, is it subscription-based models that seem to be a better revenue stream or what?
I think subscription-based models, yes. I think niche properties are growing, so people want to be in digital communities where they feel valued, and so they're willing to pay for that. So subscriptions are going up. We're seeing, and on top of subscriptions, we're seeing events as a major driver. People want to be a part of a community, and so if you can diversify your events, if you can diversify and maybe expand how you're talking to folks.
Right.
So maybe you have a publication and a podcast and a newsletter, right? And so there's multiple types of revenue, even building other for-profit streams, whether it's like paraphernalia and selling items as well. So we're seeing a couple of different models that are working.
You come to an event like Milken, right? And we know financial industry really dominates this, but they get into media, they get into culture, they get into healthcare, they get into so much, they get into politics. What is it when you come to an event like this? Like, who do you want to talk to? Who do you want to hear from to kind of learn about what you need to be doing even more?
Yeah, we talk a lot to finance folks, so folks who are in traditional venture capital. So NNV bridges the gap between philanthropy and venture capital. And my mission here this week, we need them both, right? Yeah. And I want to tell people that media is still a viable business model. It's a viable sector. Just as much as we're seeing local news and the traditional news take a hit, we're seeing deal flow like we've never seen before. 2 years ago, we used to get 50 new deals, media deals a month. That number has steadily increased with viable business models that we need to be resourcing. So I think that it's a sector that we want to continue to engage, pull more people into. So I'm looking for the investors. I'm looking for people who care about democracy and finance as well.
I am curious about some of the pushback we've seen on projects, like some of the ones you're involved in. You talk about building media brands, but as you know, you also have folks out there trying to build media brands that are specifically sort of slanted towards one side of the political spectrum or another.
Yeah.
I guess I wonder, even if there is a middle ground there, do you run the risk of being tainted as being on one side or the other, and does that limit the investment opportunities?
You do, and we do, right? We talk about building a progressive world, and a lot of folks associate that with Democrats.
And you know that just that word alone, it's a dirty word for a lot of people, progressive.
It is.
Yeah.
And I think, in our society, we have to move toward the middle. I think we have to be able to increase the level of stability in our discourse. And I want to get good information out there. And so a lot of our properties are what we call cultural media properties, where people are aligning around communities, around identities, around shared interests. And that isn't partisan. That is meeting you at where you are, at your place of interest, to say you have a role to play in this democracy, in this society. I want to give you good information to help you be active in whatever way that means to you.
When we talk about bridging that gap between the nonprofit world and the for-profit world, particularly in the financing space here, how are you going to measure your success? Because it's not just all going to be about financial return.
Correct. So we are patient capital because it's impact investing. And so, the thing about NNV is that we are a network of supporters of investors. And so we're first check-in, but we really leverage our angel network to co-invest with us. And that's the power that we have as an investment entity. So for us, it's about partnership and bringing more people to the table and expanding who gets to invest in these companies as well, along with us.
What's the toughest part of what you do? You've been doing this for some time, and you've seen it. Different capital cycles, I'm assuming at this point.
Yeah.
What's the toughest part in kind of helping grow?
Limited capital.
Yeah.
Most of our investors care about what we're trying to do, the impact of what we're trying to do, and so they are patient as well. But being in venture capital, not everybody has that sort of, we can wait 5 to 10 years to see a return profile.
Where do you think could be tapped even more? It's interesting. I just came off a discussion with the SBA administrator, Isabel Guzman, and talked about, we came off the pandemic, seemed like capital and funding was opening up to a much more diverse group of people. And then here we are again, Black entrepreneurs are having a tough time, getting funding. They're tapping credit cards to do their own small businesses. Why are we here again? What could be tapped more in your view to help support a more diverse set of startups, if you will?
Yeah. I think one, just because they're diverse doesn't mean they don't have implications across the nation, right? They're building businesses that impact our entire country and shouldn't be just sort of like siloed into this sort of like you're only helping that part of the country. I think that, the capital stack has swung against Black and brown founders. We're seeing, to your point, them using their own resources to start. I think for us,
are expensive resources if you're tapping a credit card or something.
Right, and I think in this market where people are scared, there's so much capital. We raised so much capital between 2020 and 2022. All that capital still exists, it's just not being mobilized, right? When we have financial scarcity, what we do as investors is like pull back on risk. And minority founders are considered a riskier bet, which is sort of counterintuitive based on what we've seen. Our minority-owned properties excel. They do really, really well. Blavity, the juggernaut, Pulso, Parents Together, like these entities are doing really well because their communities find value in them, and they're preaching to a larger sort of U.S. national debate.
All right, Carlissia, you're going to have to leave it there. Real fascinating stuff here. Carlissia Graham over at New Media Ventures, helping us kick off our third day of coverage here from the Bloomberg stage at the Milken conference. And we talk about the whole idea of social impact, and the idea that I think a lot of these folks would have normally been in the nonprofit space, right? But they're realizing that to get the effect of change that they want, you have to do it in a for-profit way.
Absolutely, and ultimately, you need to have the capital access or access to it to really grow the business. You can get to a certain stage maybe on your own or with some startup, but you really need a lot more to kind of build it out.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, a story that we've been talking about this week, and to be fair, here at Milken, is that it pays to be in treasuries. Last year, investors pocketed nearly $900 billion in annual interest from U.S. government debt, double the average over the previous decade. And that is set to rise as just about all treasuries now carry yields of 4% or more. In March alone, the Treasury Department paid out about $89 billion in interest to debt holders, or roughly $2 million a minute. We're here with more on U.S. treasuries and really the financial markets overall. A great voice, Ann Walsh. She's managing partner of Guggenheim Partners and the chief investment officer of Guggenheim Partners Investment Management. And nice to have you here and be talking with you.
Nice to see both of you.
You know, it's interesting if we think about where we were last year. People were concerned, right? Regional bankings, recession, where are we going? Higher rates, what's going on? And yet here we are and we're surviving and there's actually enthusiasm. What does that tell you about kind of what is going on more broadly in the outlook?
So when we sat here last year, there were recessionary pressures in the system. Believe it or not, those recessionary pressures are still there. But there's been one big difference, and you talked about treasuries, and that's been the fiscal spending. It's really supported the economy in the U.S., even while the Fed has been tightening during the quantitative tightening process. And what you've seen is globally, other central banks tightening, but they didn't have the fiscal stimulus effect that we had, so they slowed down. Whereas we're still slowing, but at a slower trajectory than we would have anticipated last year when the Fed was very active in quantitative tightening.
How does that complicate what the Fed has to do? All right, fiscal spending, great growth. Jay Powell says, hey guys, we're growing, but yet some of that velocity creates inflationary pressures.
Absolutely. And what we've seen is that in quantitative tightening in the U.S., the balance sheet has been reduced from $9 trillion down to about $7.4 trillion. But when you think about the fact that deficit spending has been to the tune of about $2 trillion in that same time frame, it's really been almost perfectly offset by fiscal deficit spending at this point. And that is inflationary, and it makes the Fed's job harder. It's two forces working against each other.
Has it made your job easier, at least in terms of finding opportunities to invest?
Well, absolutely. Yeah. With a resilient economy, and by the way, usually, periods where the Fed is on pause, which they are, and we do not see a rate hike, we are not in that camp, that's a very good time for credit, for fixed income investments, particularly investment-grade fixed income, and also for risk generally.
I have to ask you, though, about the health of the market, particularly the Treasury market. Lisa Cook over at the Fed, she was just speaking a little while ago, talking about she had some concerns about Treasury market liquidity. And this has been a conversation that's come up before. I guess for you, does it matter? And B, if there is a liquidity issue, how severe is it right now?
Well, liquidity is a concern, but I really don't see it as a short-term issue. Right now, there's plenty of liquidity in the system. If we think perhaps more big picture, since quantitative tightening started globally, $5 trillion has come out of the system. But when you think of that in context of where we were pre-COVID and how much has come in since the COVID, quantitative easing that occurred and the stimulus, that was $12 trillion. That means there's still an extra $7 trillion out there that still has room to, move. We have a lot of flexibility.
I do wonder, too, though, about with the fiscal spending that has also come in. Does that heighten the possibility of the Fed making a misstep in trying to deal with that and try to explain what's going on?
Well, I think there's a lot of skew in the numbers.
Yeah.
And what's really seemed to have happened is that the timeline has extended. So normally you'd expect in prior cycles we've seen where the Fed starts tightening, they start to slow the economy, we get recessionary pressures, recession happens, and then ultimately inflation comes down. This timeline has extended quite a bit. We've seen that we've been inverted on the yield curve for 22 months approximately. We've seen leading.
It's amazing.
It's amazing.
I forgot all about
did
the
too.
Unprecedented, and that's tight in its own effect. But because again the fiscal stimulus has offset it, we haven't seen that impact. But as I said, the recessionary pressures are there. Leading economic index peaked about 22 months ago as well.
Yeah.
So,
one question though,
yeah,
I
go.
do have, particularly about the yield curve, because I actually kind of forgot. I remember we were all
stopped
obsessing
talking
over
about it.
But I mean, how reliable are these sort of, I guess, traditional historical signals that we always look to see when times are rough? Because a lot of those signals have been saying times are rough, even though it looks like times have been pretty good.
And it's different this time around.
Right. Well, it's really just extended. I think what we're seeing is just an extended timeline, relatively speaking. I do not think it's different this time, but there are different elements, and those have to be factored in. And when we sat here last year, we really weren't aware of those. We have what we're in I want to call it a COVID echo, which is we still have spending out there that's been authorized by the government, but yet hasn't been actually, sent out into the system. So we're going to still have more fiscal stimulus, for a while. And so that's why I just say the timelines are extended. But I don't think the cycle is dead. I don't think this time is going to be completely different, just longer.
So what should investors be doing right now? Like, what should they be setting up for maybe 6 to 12 months from now?
Well, I think ultimately by the time we get to the end of this year, some of that fiscal stimulus will be less. And as a result, it's a good time to be thoughtful with regard to risk positions. We think being, defensive, if you will, in credit. So that's investment grade credit, great trade right now. Also, parts of the high yield market, particularly the higher credit quality part. I'd avoid the lesser credits. We still have some risk, being rationed at CCC rated credit that I'd be thoughtful about. And you could see some spread widening there. But historically, when the Fed's on pause, this is a good time for credit.
I have to ask you about geopolitics, and particularly with the election cycle coming up. Does an election cycle at all change how you operate in the months surrounding the election?
It doesn't really. Markets do a bad job generally of pricing in geopolitical events, and that includes the U.S. elections. But on the other hand, I think that being thoughtful about the amount of volatility that could be introduced into the system as we go through the year, that's going to be an important element. And, it's always a question when you do have the Fed tightening, you have to think about idiosyncratic risk. And so you have to be thoughtful more broadly about that generally. And that's just one other element.
What's the big risk on your radar that you're really keeping an eye on?
I think the big risk is always a surprise. We don't see one, but there is one element, and that's commercial real estate, and particularly office properties, that right now is not a really surprise. It's just an unfolding storyline. And I think it's going to be an unfolding storyline for the next several years.
Well, do you think as we kind of hit the loans that have to be refinanced and reworked, right? We're hearing a lot of conversations about it. They really go next year, the year after. Is that when we start to see some of the problems work their way through?
Yes, there's about $1 trillion of commercial real estate that has to be refinanced. And as those maturities arise, we're seeing more and more what I call, maturity defaults.
Right.
You don't have a sign that they're going to default necessarily because they're paying interest and principal along the way, right up until the time of maturity. That's what we're seeing, and it's going to take a while to unfold.
Just 20 seconds, will it be manageable, do you think, in terms of the markets, or is it a mini crisis, a big crisis?
I think it's an evolving, backstory.
Yeah.
I think the markets are going to be fine, but I think small banks, regional banks are at risk, and I do believe that the commercial real estate cycle is going to continue for the next 2 or 3 years.
Great stuff. Ann, thank you so much. Ann Walsh of Guggenheim Partners. So appreciate it. And I feel like what's great is we're hearing things, yield curve, we stopped talking about it. Concerns about a recession. I feel like nobody's been talking about it, but it's something that we need to consider.
Yeah, there's still caution out there, but not necessarily, I think, the trepidation that we saw saw about a year ago when everybody was on this stage and really kind of pulling their hair out about the Silicon Valley Bank,
right.
Of course the Fed, and then of course the potential for a recession.
Right, and you think if you're doing portfolio management, like you've got to be thinking about, okay, where are we going to be maybe 3, 6, 12 months from now, and just plan for it.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One of the interesting things, Carol, about this event, right? This is kind of the domain of private capital, private equity, private credit, really, here. But this year, you're seeing a lot more of the bigger players, the bigger banks, the bigger asset managers who didn't necessarily have a presence in years past.
No, and it's really fascinating to hear, like, the conversation around private credit. It's not just about what they are doing now that banks no longer want to do. It's more about collaborations, partnerships, and we've had a couple announced, actually, this week.
Yeah, that's been a big theme, and I think our next guest is really in tune to that. Jason Thomas, that really links it all together. Yes. He's the head of global research and investment strategy at Carlyle, really helping craft investment strategies and economic outlooks. Jason, great to have you here. And I do want to start here with this idea of the banks kind of pushing back, if you will, or maybe pushing back is the wrong phrase, but they certainly not faded into the background.
No, absolutely not. I think what we've learned in 2024 is there's an emergence of new competitive fault lines. It's one thing to separate banks from their assets. That can and will continue. This trend of bank disintermediation really started in the 1970s. You know, the basic business of taking deposits to extend loans peaked then, has declined steadily since. But it's quite another thing to separate banks from their clients and their customers. Because when that happens, it deprives banks of the ability to cross-sell other services on which so much of their income depends.
I'm glad you characterize it that way in terms of kind of being separated from their customers. How do they sort of narrow that separation, make sure they still have that connection with, of course, not running afoul of any of the financial regulations?
So, you know, this year you see bank intermediated leveraged loan origination volumes that are at or near all-time records. So this is the bank stepping back in a big way. And again, I think this is really that these lending decisions very sensitized to the sorts of borrowers. As private credit direct lenders have stepped up in size, they've started to threaten bank relationships with these large, very lucrative customers. They could be IPO candidates. They may be acquisitive businesses where there's lots of M&A activity, transaction services, et cetera. So if you look at the largest bank holding companies, about 1/5 derive more than 3/4 of their operating income from non-fee sources. You know, again, precisely these M&A transactions, IPOs, et cetera. So this is really what we've seen, that private credit above a certain size threshold, it starts to generate a very vigorous response from the banks. Now, it's important to note, this is still disintermediation. The banks retain some of those credit packages in the form of commercial credit lines, revolvers, but for the most part, those term loans are distributed and end up on non-bank balance sheets, principally CLOs. So still disintermediation, but of a metered sort that allows the banks, again, to maintain the relationships, collect the underwriting fees, et cetera.
It's interesting. You know, I've been talking a lot about this morning, talking to the SBA administrator, Guzman, and wants to do more direct lending, wants to work with private equity, and they do some of this. But the concern is the pushback from members in Congress is that, well, wait a minute, by doing that, you are robbing some of these small businesses of their relationships with their banks, which leads to other services and so on.
That's right.
So how are you thinking about the relationship between traditional banking and private credit, which just gets bigger and bigger and bigger, and the ability to do bigger deals and services? How does it evolve then over the next couple of years?
Well, again,
how should it?
I think the game moves from adversarial to cooperative. I think that's the way to characterize it. Again, you said the relationships. Estimates suggest that the value of a relationship to banks is generally worth 12% of the principal balance on the loan.
Right.
And you could just think of that as the present value of all those services, over time provided. So I do think that, for example, if you have a corporate borrower who is no longer going to have a unitranche for private credit, if a bank steps in, that's only going to be a first lien. There needs to be junior capital. That is going to be a private credit solution. there are other areas, smaller borrowers that aren't as lucrative in terms of a fee perspective. I do think private credit is going to continue to grow in that market, infrastructure. So there are lots of other places, and again, in the cooperation with some of these loans,
right,
where you're going to see the banks and private credit collaborate.
Jason, you're here smack in the middle of Milken, right? It's all about the financial industry. It's traditional banking. It's the private credit players, the private equity players. You guys are here. I am wondering, where are the conversations that are happening about how the two sides need to collaborate more?
No, I think that has been a real theme, which is, again, interesting, because this is the topic of the paper that we released. And just, again, moving through, it's game theory, right? It's just how do these two actors cooperate as opposed to...
Do they want to cooperate?
I think so, and I think it's precisely, again, there is an issue with some direct lenders, where as the money has flowed into the industry, they've naturally wanted to step up in size.
Right.
And so there needs to be a recalibration there. In much of the rest of the market, again, I think it's either fair game for the direct lenders or more of those collaborations. But overall, I think that the other takeaway from the conference, I think, is the sense of optimism about the U.S. economy. And a year ago and beyond, there was just a sense that there was no way this economy could withstand a rate shock of this magnitude. You don't really hear people talking like that anymore.
Is that a U.S. story, or is that global as well, the optimism?
I think that the optimism globally is about how cheap assets are in the rest of the world relative to the U.S. That's both because of the strong dollar and just lower valuation ratios. But one, I think it's very important, you saw the Riksbank cut interest rates today. I think that you could really explain that based on the differences in the structure of the mortgage market. In the U.S., the household sector, 70% of the liabilities are long-term fixed-rate mortgages. Households still only paying 3.8% on average on that $13 trillion stock of mortgages. So they're really hedged, continue to spend, the economy's in good shape. Elsewhere, and particularly in Sweden, you see with adjustable rate mortgages, this huge shock to household cash flow, depressing spending, actually leading other central banks to cut. So I think in Europe and elsewhere in the world, you're going to start to see central banks with 2, 3, maybe 4 rate cuts this year, again, could put upward pressure on the dollar, help stabilize those economies, create even more attractive buying opportunities for U.S. investors abroad.
So that differential, though, assuming the Fed doesn't really do much this year,
yes,
that differential doesn't become problematic?
I think it's going to have downward pressure on the currencies. But again, from a U.S. investor perspective, your dollar is going to go even further abroad, later this year.
Got to ask you, you understand Washington like a lot of other folks do not. Special Assistant to the President, George W. Bush, you also are on the National Economic Council. What do you think about policies that are coming out of Washington? There's a lot of spending. A lot of it's going to build out the semiconductor industry and other industries. But what about broadening it out to more Americans, where we hear still there's a lot of equality or inequality, if you will, inequality out there?
Well, I do think when you look at, we are in the midst of an investment boom in the U.S., fixed investment. If you look at semiconductors, if you look at data centers, if you look at, we're adding 63 gigawatts of renewable energy and storage to the grid. There's 30 battery plants in various stages of completion. So actually, when you look at construction workers, the payroll growth over the last year is over 3%. It's 3 times the employment market as a whole. So I do think that this is the fixed investment in these industrial structures is making a larger contribution to U.S. GDP than it has in the history of the data, which date back to 1945. So, again, I think that these sorts of construction activity is actually broadening. And again, construction workers participating in wage gains, more employment opportunities, et cetera. And I think it's going, all signs suggest this is going to continue.
Anything else you'd like to see the administration doing in terms of helping more?
I'm disappointed in the election discussion that deficit reduction is not really at the center. I think if you look at...
A lot of people here talking about it.
When you're running deficits to this magnitude at full employment, what it suggests is if you have a recession where tax receipts fall, transfer payments rise, you could have a deficit of 9 or 10% of GDP. And so one would think a central question of this election would be, what are your plans to reduce the deficit, to have it more sustainable so that the debt is not growing faster than the economy? So again, it just feels like a dog that's not barking during this election campaign.
When does that sort of rear its head, though? Because, it's one thing to say that it's a problem, and we know that for a lot of voters, rank and file voters, it's just not something that's on their radar. They're more concerned about issues that are a little closer to home. So when does it become a critical factor that the politicians will be forced to address?
I think that there is a risk of an upward move in long-term yields. Just that, and so, for example, this year, and if you look over the last 15 months, most of the debt issuance has come in the form of Treasury bills. It's not notes and bonds. In fact, Treasury bills last year accounted for over 80% of the net cash raised by Treasury. So we haven't yet seen this huge supply of bonds and notes necessary to cover the deficit. When that comes online, perhaps at the end of this year, again, you may see some upward pressure. And then at that point, if you have yields, 10-year yields above 5%, 5.5%, well, then it starts to become something that I think really focuses the mind on the need for deficit reduction.
Well, I have to ask you that broader existential question. I'm just going to play devil's advocate. You know there are people out there that will say it doesn't matter as long as we're the reserve currency, as long as we're the jewel of the global economy here. Do those deficits, are they really going to matter?
Yeah, no, I think that one could have that point of view today, but when you push on the deficit, when you're asking, so, for example, we've been through 20 years where not only central banks had accumulated treasuries, but of course reserve managers in the rest of the world. China doesn't seem to be buying many treasuries anymore. Of course, it's also diversified its external investment through BRI, through infrastructure investments in much of the rest of the world. The Gulf states, particularly Saudi Arabia, have very ambitious domestic economic transformation plans. So they're not really having the surpluses to invest back into treasuries. So I do think that some of the attitudes about this not mattering could be really conditional on this 20-year period where there were so many buyers for these securities. And of course, the debt issuance is much lower.
Well, does that mean, are you worried that we're not going to have buyers out there?
It's not that there won't be buyers.
Debt?
The question is, what is the price that this market is going to clear?
Okay.
And I don't think we're appreciative of the risks of some upward move in yields. It's not a buyer strike.
Right.
It's just, again, what is the yield that is going to clear this market?
It kind of speaks to, generally, right, the environment out there that everybody says it's going to be a higher rate environment longer.
Yes.
We know the Fed says it, but even there's a lot of factors at play.
And I think from a political perspective, if you go back to the 92 election, the campaign, when President Clinton talked a lot about deficit reduction as being in the interests of voters, precisely because it would lower interest rates, because it would make mortgages more affordable, it would make car loans more affordable. I think we need to start thinking in those terms and, again, communicate deficit reduction to the electorate on those terms.
Yeah. All right, well, maybe after we get through all our culture war battles, we'll get to the real substance of this economy. Jason, great to talk to you. Jason Thomas, who knows more about this than anybody.
That's a little worrisome.
Carlyle, heads of research department over at Carlyle. Yeah.
I have to say,
I feel like we're so distracted, right? The culture wars and all this, and then, you kind of overlook the real economic issues that have real impact on people.
There's a point you can ignore something like U.S. government debt or the rise of it, and then there's a point where you're like, you've got to deal with it because it's going to have implications. So, great conversation.
Yeah, great conversation. A lot more coming up here on the big program from the Bloomberg stage at the Beverly Hilton at the Milken Global Institute Conference.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, well, our next guest participating in a panel I moderated here at Milken. It was called Thriving in Disruption. And it was a conversation that got into some of the changing and charge dynamics facing investors today, including the impact of generative AI on our power needs. We talk about that a little bit. Our power needs and the end of a 2-decade-long disinflationary environment. Also, we got into longevity and its implications on everything from pension obligations to housing and healthcare. We covered
How long was this panel?
60 minutes. Lucky for me, on that panel was our next guest. With us is Laurence Gottlieb. He is chairman and CEO of the Alternative Asset Management Fundamental Advisors, active in both the private equity and credit space. He sees a lot. Hello. Thank you for coming by.
Nice to be with you, Carol and Romaine. Thank you for having me.
Well, it's great to have you here. You invest private equity, private credit, but community assets is what you do.
Yes.
Remind our world and remind the Bloomberg audience a little bit about what you do and what that tells you about what's going on more broadly here.
Sure. Fundamental has, since inception about 18 years ago, cared about community assets that support the communities that we serve. So that could be affordable housing, seniors care, infrastructure assets, inclusive now of a large practice in renewable energy, where we lend to late-stage developers as well as the construction needs for putting solar energy onto the grid. It's a large practice that we've gotten pretty involved with in the last half dozen years or so.
Well, one of the things that came up on the panels, we talked a lot about generative AI.
Yes,
in
we
a
did.
Big way. We did. The energy needs, right? We're kind of going through the investment cycle. We've seen the NVIDIAs of the world really kind of certainly rally in a big way, but we're thinking a lot more about the energy intensity of generative AI. Talk to us about how that is impacting you.
Well, as we construct and develop these sites, of course utilities or other corporate off-takers are interested in the renewable green energy, and the overall demand for energy boosted by all different drivers, but AI being one of them, has certainly knocked on our doorstep with folks wanting dedicated sites where they can take our energy for themselves.
Well, that's what I'm curious about. How fast might we see that in terms of the reliance on renewable energy to power some of the, whether it's the data centers or the other sort of AI components that go into it here? Are we going to see that speed up a little bit?
I think so. I think you have some of the building blocks in place, and actually some of the hurdles now are not the technology resident in the power generation itself, but instead there's other stopping posts. For example, storage technology in renewable energy is a big thing, and it's coming online and it's getting better and better. These are batteries. We use the word storage that can provide an even supply of energy to the grid. Another is the interconnection on the grid side. Right. So that's one of the holdups now.
Is there interconnection? It almost seems like there is none.
So yes, you understand the issue, but that's an area where we're going to have to improve.
Is that something that can be addressed? Because you're talking about state by state jurisdictional issues, and probably what I would assume would end up being probably a Supreme Court case if the federal government ever tried to step in.
All I can tell you is some are better than others, and some are much more focused on this, and that tends to be where the industry, wants to be: California, Texas, Florida, etc. So those are areas that are advancing, and others, Mid-Atlantic states that have more of an experience with community solar and other contributors.
Hey, Laurence, just saying with the data centers that are going to be needed to power AI, does that help kind of push us over a tipping point in terms of the adoption of renewables? Is this the thing that does it because the energy demands are so intense, or is it the fossil fuel energy that's going to kind of tap into all of that?
Yes and yes. Okay. So one of the things that I'm most excited about is solar energy at this moment is cheap to deliver to the grid, away from the subsidy from the government. Now, the Inflation Reduction Act and other subsidies have always been prevalent, but subsidies are prevalent in all energy. And now solar is the cheap energy to deliver to the grid, meaning on a standalone basis. We are, through legislation and through our own activity, commercial activities, bringing more of that onshore, which is good. And so the demand for energy, the fact that it's renewable, government mandates requiring green energy by certain dates, all these are contributors, and I think we're all moving in that direction. But by the way, a long, long way to go. We've been in the business for a half dozen years. We started with $25 million investment. We've now deployed $6 billion in the space, and we think we're not in the first inning. We're scratching the surface. So
I want to ask you about kind of the other side of your business, these community assets, whether it's affordable housing, workforce housing. You also do senior care. Talk to us about those. Why are they so investable, and what kind of activity are you seeing in that front?
We think each of them are investable, and the reason is because communities depend upon these assets to enrich, the whole value of that community. So affordable housing still very, very costly to deliver. Existing supply is constrained, the need is elevated, and so we understand that currently there are rate pressures, supply chain pressures, and other inflationary pressures on the asset class, but over the long course, the need for safe and affordable housing is a for sure demographic certainty.
It's almost at crisis level, and we've heard a lot of local municipalities, including in New York, where we're normally based, they've actually reached out. They've basically said, look, we're looking out to the private sector to help us with this problem. Have you had conversations with some of these municipalities about how private money can sort of help facilitate this?
I'll give you one example, and it's at a certain point along the spectrum, but it's all over the spectrum. In New York, you have something called the Right to Shelter Act. That means that anybody in New York who cannot afford housing can raise their hand and ask the city for housing. And the housing, it's the obligation of the city to pay for that housing. We have now partnered in New York with nonprofits to deliver cheaper and better for the residents housing to homeless people in partnership with the Homeless Services Department of New York. So yes, governments care about this, and folks understand that it's necessary for the fabric of the community, whether it be a legal obligation or not.
Right. Do other investors, though, get that?
I think so. I think, you've seen some decline in some of the key cities, for example, in the Pacific Northwest. And other cities understand that there's a better way, and that will lead to better results for the whole city.
One of the things that came up on this panel discussion in our prep call is you guys all got into longevity issues. And no joke, we talked about pension obligations, we talked about housing, how we need it. Senior care is something that you are actively in. Investors who are listening, what's the growth that you are seeing in that sector?
Well, currently, capital markets are constrained for new development because of the debt capital markets. People can't borrow to build new. The demographic has always been and remains a big driver for seniors' care. Quality care for seniors is something that, in our view, has been investable since our inception and continues to be investable. We have specialties, memory care, assisted living, etc. Particularly the memory care needs of that demographic are growing significantly. So facilities that address Alzheimer's, dementia, other type of issues like this are very much in need.
Is there a lot of overlap in terms of those particular projects? I mean, if you're focused on, say, on a memory care side versus just, I guess, just say a more traditional long-term care, and even combine that with affordable housing?
The answer is yes. We have developed a specialty for entrance fee facilities where folks come in needing only minor care and then can choose as they need assisted or memory care all the way up to skilled nursing. Okay. So those are called CCRCs, which you're familiar with, and they are gaining traction. We've been involved in that asset class since inception.
Well, great to check in with you again. So appreciate it. Laurence, thank you.
You're terrific. I appreciate you having me. Thank you, Carol. Thank you, Romaine.
Thank you.
Of course, Laurence Gottlieb of Fundamental Advisors. But I think what's great in having a conversation with someone like Laurence is that there are things, housing needs for different sectors. You talked about immigrants who are coming in who are having trouble finding homes, but the elderly population, which continues to grow year by year.
I'm always amazed at that because I always feel like it's such a complicated investment because it's not just about cutting a check and waiting for the return.
No.
You're dealing with local politics. You're dealing with, obviously, social pushback. People don't necessarily want these things in their neighborhood. So how do you navigate all that to find an investment that's actually going to pay off?
That's right. When the demand is there, but building out that supply is not something you just flip a switch and do it easily. We know it's pretty complicated.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, some of the talk of Milken right here on the Bloomberg stage at the Beverly Hilton, and a big part of that talk is really geopolitics.
Yeah.
A slew of elections this year around the globe, including a big one here in the U.S. You still have a lot of sanctions out there. You have trade tariffs, and of course, two active wars going on right now. So how do you navigate that all? Our next guest is one of the folks that you have to pick up the phone and call, because there is that balance between some of those concerns and the optimism out there with all of those geopolitical issues bouncing up. Dan Tannebaum is a partner over at Oliver Wyman. He leads their global anti-fin crime practice, also a senior fellow over at the Atlantic Council. Daniel, great to have you here on the stage. I mean, what is the big thing that people call you about? Are they concerned about the war in Israel and Hamas? Are they still worried about Ukraine? Are they worried about our own election here in the U.S.?
Honestly, I feel like the reality check at this conference, because there is so much going on in the world. There are two active wars going on. What I get calls from clients on is when there is an event like steel tariffs come in or other sorts of U.S.-China tensions, what do we have to do? How do we operate as a business? Are there any meaningful decisions we have to make? And so that's where geopolitics really has played a huge role this week in terms of helping companies look around the corner to think about what aren't we considering as we look at our go-forward investment strategies.
A big part of that is sanctions. And of course, once Russia invaded Ukraine, you saw a lot of those Russian sanctions ratchet up. And obviously, with what's been going on in the Middle East, you've seen increased sanctions on Iran and stuff. So those are kind of the no-brainers, right?
Yes.
I mean, you kind of know, okay, stay away from Iran, maybe, dial it back on Russia. But what about other regions? Are there concerns that clients might have saying, should we be concerned about this country or this region could be the subject of sanctions down the road?
No, I think it's the right question. And actually, just this week, the U.S. Treasury Department has a delegation in Malaysia and Singapore, which are refining Iranian oil and reselling it onto the broader market. And the U.S. government has been relatively reluctant to touch enforcing oil sanctions for fear of messing with the prices in an election year. So there's other countries that have been known to support Iran, that have been known to support Russia, the UAE, India, Turkey, South Africa. All of these countries have essentially gotten visits from the U.S. government, the EU government, UK government over the last 2 years to help them make a choice. And so business leaders need to be aware of these other countries that are still actively supporting those that could be on the wrong side of a conflict.
Dan, it's situations like that remind us all it's really complicated, right? When you want to make maybe the right thing to do, but, there's a business or economic consequences. Having said that, so, we are talking so much about companies doing nearshoring, bringing things home, having a second supply chain because of the concerns of geopolitics and the pushback and strained relationships between nations. Having said that, when you are talking to companies, are they really doing it or are those ties still there?
So, no, they are doing it. I think if COVID had helped anyone, it was to understand that supply chain resiliency is a thing. And that has come up throughout this week. Companies are looking at alternative supplies of rare earth minerals and other commodities needed in their supply chain because of fear of actually being cut off from certain markets. China's begun imposing outbound restrictions where, like, gallium is banned from being exported into the United States. So there's a whole host of things that companies are being aware of, and there's tools they're implementing to monitor their supply chain to look for those points that could either be at risk of disruption due to geopolitical risk, natural disasters. People are much more acutely aware of that type of risk end-to-end in their supply chain now.
When you talk to global companies, who are they likely to push back more against? Is it Russia? Is it China? Who is it?
I mean, Russia is, with the exception of what they're still providing on energy, rare earth minerals, of uranium, they're pretty far removed from the mainstream of the global economy, but 2/3 of the world's population is continuing to trade with Russia, which is not an insignificant number. I think there is more fear of being on the wrong side of China, although we saw yesterday the head of a sovereign wealth fund said if the U.S. government asked them to divest, they would, which was not something you would have expected to hear from a Middle Eastern government and a sovereign wealth fund at that. I do think people are afraid of alienating China more so than Russia, certainly.
But there's still, to her point, though, I mean, obviously the search among governments as well as companies for resources that aren't tied to China or to Russia for that matter. We've seen the U.S. try to strengthen ties with other nations, obviously with India. And of course, now they've sort of, renewed their focus on Latin America, which seemed to be a focus that we kind of lost for quite a while.
Yeah, on Sunday afternoon, Senator Dodd, who President Biden has appointed to focus on the Americas, has talked about the trade deals, really using the carrot to bring Latin American countries in line that have very critical natural resource deposits that can be used. So the U.S. government is very acutely aware of the needs to bring the global South on board. The question is, did they wait too long to really do that, where China had been making investments for years?
And it's not just Latin America. I mean, we waited too long in Africa, and now we're seeing the dominance of China and Russia and a lot of those countries.
I was with the chairman of one of the largest banks in Africa on the sidelines of the IMF World Bank spring meetings, and he said, when bluntly asked, I'll take capital from anywhere. We don't really care where it comes from.
Well, so in terms of the U.S. administration, the U.S. government, are they willing to kind of step up and ramp up those efforts, even though they've fallen behind?
I mean, that is the question. I think there is a severe...
Is there the political will?
The political will is there as companies have begun realizing, well, wait a minute, if China withholds certain minerals that we need to make semiconductors, then we can't make semiconductors, and that has to come from somewhere else, or you disrupt a much broader supply chain. I do think the will is there. The question is, how quickly can we implement some of these trade agreements to get mineral rights and access to rare earth minerals needed?
What do you think is the timeline that we have to do that?
I would expect to see some movement before the election, frankly, because I think even regular Americans understand that I can't get a car because semiconductors are backlogged because of other disruptions in supply chain. And by the way, that also means it's more expensive. So I do think not just the Bloomberg audience, but regular Americans may understand that this has real impact.
I was thinking, we all kind of freaked out we couldn't get toilet paper during the pandemic. Well, wait until you can't buy any appliance, anything,
and it takes
there
years.
Aren't the chips.
And it takes years for that to really flow through to see that disruption.
Well, it's years to actually sort of build up the capacity to do this. I mean, if you want to start, I don't know, a copper mine or something else, even if it got approved, how long does it take to get that up to critical mass? But going back to the approval of something like that, you're still now bumping against other agendas, which, whether it's climate change or renewable energy, things like that. So how do you find that balance?
Well, I mean, you just don't talk about the things you're bumping. So 60% of the world's solar arrays are made in Western China.
You're a politician?
No, but I used to work with them.
I know.
60% of the world's solar arrays were made in Xinjiang, China, which is known for massive forced labor issue. I remember Tom McKenzie's last story before he left China was at one of the plants. We're not talking about solar as much because you can't rely on the arrays that you need that are coming from a very unsavory part of China from a human rights standpoint.
Go ahead.
Well, I'm thinking. Well,
because I got a big picture question.
Right,
I know you're going to ask something smarter, so go ahead.
I doubt that. But is there a new relationship that the United States and companies in general in the U.S. are having with the Middle East? There's so much money going everywhere and coming out.
The Middle East is complicated. There's obviously a lot of very strategic allies like Bahrain that has one of the largest aspects of the American Navy outside of the U.S. But then you look at what's happening in the UAE, for instance, where there's also been a U.S. government visit to remind them there's a lot of Russian assets that have come here. There's a lot of Russians that have come here. They may not be on the right side of a broad Western coalition. What are you going to do to police that?
I have to ask you a big picture question. I think I asked this of you before last time we spoke. And it's really about kind of the state of globalization, at least as we kind of what we know it to be coming out of kind of the post-World War II era. Is that over, or are we just kind of seeing an adjustment of it?
No, that is the one thing, and even at this event, globalization is here, it's alive and well. I don't think anyone is saying it's going anywhere. And you've heard from people across ASEAN and China and U.S. investors, everyone's agreed it can't go anywhere. There's such reliance on that. So no, I think globalization is here to stay. The decoupling narrative, certainly with U.S. and China, is, I think, totally false at this point.
But the sort of a hierarchy right now, China sort of trying to rise. I mean, we're seeing Xi go through Europe. He's in Hungary today, right now, obviously trying to assert himself. And you have other countries that would love to also be in those shoes.
Yeah, I mean, right now it is a race to try and influence countries that are largely caught in the middle between the U.S. and China. And while China and the U.S.'s relationship cannot truly be divorced, you can bring other friends closer, and that's right now what you're really seeing.
All right, Dan, always a great insights. Daniel Tannebaum there, partner over at Oliver Wyman. And I think, really to his point about the U.S. being behind, you just talk about the influence. I remember right before the pandemic, I did a big trip through West Africa. Yeah. And the Chinese influence was just enormous. But you did not see U.S. companies, you did not see European companies, but you saw Chinese companies' names plastered everywhere.
It's like they got the memo years ago, and they've been certainly tapping into Africa in a big way to have access to all of that.
And that gives them political power.
Absolutely. I feel like this interview should be given in the parting packet to everybody at Milken, just to take home and remember what's going on around the world.
Is there a parting packet?
Yeah, didn't you know?
Oh, I don't know. I don't get those.
I got a piece of that.
Is there like a Cartier watch in there or somewhere?
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, I've got to say, stocks across the world, they have staged a comeback so far in May. A little bit of a different mood today, but really we've seen an uptick in stocks. It's really been fueled by prospects of Fed rate cuts and solid earnings, though, as I said, the pace of the advance easing off a little bit today. Federal Reserve Bank of Minneapolis President Neil Kashkari said it's likely the central bank will keep rates where they are for an extended period of time. Our next guest says future financial conditions and overall health of the U.S. economy, well, it remains an open-ended question. So let's bring in someone very familiar to the Bloomberg audience. Now here with us on the ground right here in Milken, we welcome Seema Shah. She's Chief Global Strategist at Principal Asset Management. The parent company, by the way, $709 billion worth of assets under management. Welcome. Nice to be talking with you here at Milken. Curious, as you have a lot of conversations, you've been busy like the rest of us, is there a mood that you're feeling when it comes to the investment environment?
great to be here with you. So it's really interesting, actually, because we were here last year, and the vibe at that point was, question marks about what the Fed was going to do, but we had a good idea, but there were concerns about the US economy. This time, everyone's like, we don't know what's going to happen to the Fed, and it doesn't matter, because actually the growth is so strong and earnings are going to do fairly well, so they still feel like really risk on without actually needing to know what the Fed is doing. So that is a big shift in sentiment.
Well, having said that, what's your thoughts about do you agree with that sentiment?
So I feel like you can make a bit of a bet. I think it's very uncertain, more uncertain than I can remember actually in recent times.
More uncertain?
More uncertain about what the Fed is going to do next. So we do think our forecast is that the first cut comes in September and then another one in December. But I actually have very, very limited conviction at the moment because I think the next few data prints, first of all, you need to have at least 3 weaker than expected inflation numbers in order to get them back on track. Then you've got to think about the presidential election. I know the Fed is independent. We've heard all the things that they're going to say. But ultimately, if you're going to have a change in the direction, you better be very, very sure about what you're doing, especially if it comes before an election.
This might be a dumb question, but why even start the rate hikes then if you are going to do it that slowly? Wouldn't it be better to sort of communicate an actual easing cycle of some kind and then start it? But if you just do one cut in September, I don't know, is that going to change the narrative or the dynamics much of the market or the economy?
So I think it does actually change the dynamics for the economy, because the one thing that we've seen in the last year is that every time Powell has had this victory dance, we're going to cut rates soon, financial conditions have eased and it's provided that additional boost to the economy. But to your point then, they need to be very clear that the economy needs those rate cuts. Otherwise, why make that mistake of going just for the sake of getting it going before the election if that's going to risk another resurgence in inflation? So I think they have got a very difficult balance ahead.
The economy may need it. Does the market need it? I mean, we're talking, even though we're down today, we're talking about markets pretty much at record highs for the most part, defied so many expectations. And it's not just equities. You're making money in bonds. You're making money in certain commodities. You're making money in alternatives and privates. So far, 5.5 of Fed funds rate hasn't had a huge impact.
You're absolutely right. It has had no impact. The market does not need rate cuts, mainly because it is being supported by very, very strong fundamentals. So whichever way you look at it, earnings growth is good. And not just in the US, actually in the global growth, it's not as strong as the US, but you're starting to see upside surprises. So as soon as you see those expectations increasing, that is also lifting the market.
So having said that, that's pretty optimistic. So why do you believe that future financial conditions and the overall health of the US economy is still an open-ended question?
So what we're expecting...
I do have notes.
What we're anticipating is that the next few months are very unclear about which way inflation goes. Right? The composition of inflation, we're starting to go into deep dive the small components that are impacted by idiosyncratic factors, which are almost impossible to predict. That, I think, is the open-end question. But if we're looking out over the next year or so, we feel fairly confident about the strength of the economy. But the only risk is that if you were to see a continued strengthening and acceleration in growth, then higher inflation, then that's when the thing about hard landing starts to come in early 26, but it's not our baseline.
Seema, something we talked about with Ann Walsh over at Guggenheim is this idea that there's so much fiscal stimulus, right, and spending on the government side of things, whether it's to build out the semiconductor industry that's coming into the economy, that's providing a lot of momentum in terms of growth, and it's kind of offsetting things that the Fed is doing. How does that potentially complicate what the Fed needs to do and that they make a policy misstep?
It is so complicated. I think that's one of the things that's been happening in the last 4 years, is that as long as the Fed has been hiking rates, but the fiscal policy has been there to expand.
Right.
I was on a panel, we had this exact same discussion, and it really is top of mind from a fiscal perspective. So actually one of the narratives is we're not really talking about monetary policy, we're talking about fiscal policy. What has the government got to do, and when is the deficit really going to be dealt with? So that, I think, is more top of mind than Fed rate cuts.
Do you think that we will have to address this, meaning the U.S. government, Washington, anytime soon? Or is this one of those things that we'll just kick the can down the road for another 10, 20 years and eventually we'll get around to it?
Well, the U.S. has the flexibility of being able to kick it down the road and get away with it. Maybe other countries wouldn't. I think the narrative or the discussion is going to be more pertinent this year because of the election. But whether or not they're actually going to deal with it, I don't think that there's enough penalization from the market to force the government to really deal with it today. So it's probably a few years out.
I'm curious about how this ties into the way these countries are linked right now. And let's just talk about monetary policy. We were talking with Jason Thomas over at Carlyle, and he was talking about this idea that he thinks central banks outside of the U.S. will begin easing much sooner than the Fed. And he was talking about the potential implications for that. I guess, first of all, do you think that we could see a bit of a divergence in monetary policy around the globe? And if so, does it matter?
Oh, we're definitely going to see this divergence. You're already seeing it today with the Riksbank. We're expecting the of England to move earlier, and it makes sense because their economies are fundamentally weaker than the US. US is slowing. You might be seeing some upside surprises in Europe, but they're still from an absolute level, it's very, very different story. And then from an inflation perspective, it's not as sticky in Europe as in the UK. So we're expecting the ECB to go in June. We expect the Bank of England to go in sometime in the summer. We think they will move with greater urgency as well. So it's not just the timing, but the magnitude of those rate cuts. It could be far greater than what you're seeing to the Fed, which has implications for the dollar and therefore to the rest of the world.
All right, that's a lot coming at us. So what's the right asset allocation mix here? And what's your time frame that you feel confident making that bet?
The key thing here, okay, is that this is a solid economy, so you should be risk on. This is a time to be diverting away from cash if you've been sitting there, and there are a ton of opportunities from an equity market.
I'm sorry, I think you need to say that louder because there's $6 trillion right now sitting in money market accounts, and it hasn't budged at all.
It hasn't budged, but it should do because people are still waiting. There's a kind of an uncertainty about what the Fed is doing, but you are seeing, even here at the Milken, that there is a lot of confidence about the economy. If you think about
doesn't that make you nervous when everybody feels so confident?
It's always a bit of a risk factor. I would say there's a lot of terrorists out there, but mainly one for me is geopolitics.
Yeah.
It's one of those things that you can't really time though, so we have to think about the fundamentals. And fundamentals are still strong equities, credit is good for the carry, and if you're worried about inflation, which a lot of people still are, then start looking at real assets, because that will give you some inflation mitigation.
Well, to your point though, I mean, even if you have that optimism and the confidence to make those investments, do you feel that there is a need to have a hard hedge or at least a broader hedge on some of those bets?
I think that the inflation probably is the one that you do need to have some kind of hedge. Yeah. When we look at over the next 5-10 years, and again, that's been another narrative here, is that people are saying, look, inflation over the next 10 years is going to be higher. We're not talking about 5-6%, but it's a level that we haven't seen for the last 10-20 years. And from an investor perspective, you want to make sure that you're having real returns. So start thinking about real assets, start thinking about commodities, infrastructure, real estate. Those are areas that will give you that protection.
Real estate.
Yeah.
I thought you were going to go gold because I was a little nervous.
Okay. I'm set there.
Seema, thank you so much.
Great to be
here.
here.
It's been busy, but good to find some time with you. Seema, Shah, of course, of Principal Global. No, it's interesting, right? Like I brought up geopolitics, which we were just talking about so much in a big way.
But just at the optimism point, because we always say to take digs at the people in this room, but they kind of, I mean, that's what they're paid to do, really.
Yeah.
I mean, they're there to find opportunities, and even if times are rough, they still got to make money. I mean, just because times are bad doesn't mean their LPs and their investors are just going to give them a pass.
Listen, value investor, distressed investor, that's when you find a lot of opportunity. We think about off of the financial crisis, those folks who plowed into real estate and made some really great investments. So, I think we need to think about it, right?
Yeah, I saw your ears perk up when we talked about real estate. So.
Well, I found it interesting.
Yeah, all right.
Yeah, but there'll be opportunities.
Yeah.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.